Okay, right, we continue here on our Section A question on Principle of Banking and Finance. Now, this one here, we look at 2020 exam. So 2020 exam, question number 1. Discuss the main causes of liquidity and insolvency in banking and discuss the relationships between them. Now, 2 points mentioned, liquidity and insolvency. And what's the relationship between them? Okay, now, illiquidity, liquid means cash. Illiquidity means the bank run out of cash. Yeah, insolvent means you are a bankrupt. You are a bankrupt company that's insolvent. Yeah, so okay, illiquidity, insolvency, they are not the same. Okay, illiquidity, that is a situation where the bank run out of cash, and that happen normally very fast, out of panic. Yeah, when there's a rumor about this bank is going to close down, like the Silicon Valley Bank in March 2023, yeah, then people rush to the bank to withdraw money, then they cannot hold. So that's illiquidity. So if there's a rush, we call it bank run. Yeah, a rush to the bank to withdraw money or bank run, then the bank will collapse. That is illiquid. Yeah, there's not enough cash. The bank might be a profitable bank, but suddenly there's a rumor, people rush to withdraw money. Yeah, illiquid normally happen very fast. Yeah, like in the March 2023 Silicon Valley Bank, it happened just in one night, just overnight it happened. Yeah, so it's unexpected, happened very fast, and the bank can just collapse. Okay, now insolvency is more of a long, slow process, and it's basically expected. You know there's a problem. So insolvency happen. One is the bank has been constantly suffering loss for a long time, keep suffering operational loss. Okay, so many years of operational loss, or a lot of borrower default payment, and over the year 1-2 years when many start to default, then they get in trouble. Yeah, so the Lehman Brothers, the Citibank, Bank of America problem during the global financial crisis, it is insolvency. It does not happen overnight. It's already a problem of 1-2 years, and slowly it built up to the crisis point. Okay, so that's the difference between the two. Yeah, so part A want you to explain that. Okay, now part A want you to explain that, so I give you the point here. Okay, it's year 2020. It's a bit too small here. Okay, year 2020. Question 1. Okay. Okay, so part A. Yeah. Okay. Give a little bit of introduction as usual. Bank can enter into financial distress and collapse due to illiquidity and or insolvency. So this is the point mentioned. Yeah. Okay. Now. Okay. However, illiquidity and insolvency are two distinct and separate phenomena. Okay, there's something very different. Yeah. Okay, so you explain one by one. Start from illiquidity. Okay, so create subheading always. Yeah, create subheading when you answer question. Okay, your answer in paragraph form. I just give key points so that we can do faster. I just give key point, but it should be in paragraph form. Okay. Now, illiquidity is the situation where the bank run out of cash flow. Yeah, the bank run out of cash flow. Okay. You don't answer in bullet point. You use paragraph. Oops. Okay. Now, this is normally unexpected and happen very fast. Okay, when there is a rush, when there's a bank run, we use the word bank run, where large number of depositors rush to withdraw money from the cash. Okay, withdraw deposit due to rumor that the bank is going to close down. Okay, so you give an example. You give an example. Okay, like what happened in March 2023, the SVB, Silicon Valley Bank. Okay, that overnight, okay, just one night, the bank is almost empty with cash. Okay. Okay. Before that, everything was quiet. Suddenly, there's a panic. So that's illiquidity. Okay. So bank run out of cash. Okay. So this illiquidity occur because of the nature of the bank business. The money that you put into the bank, they don't keep everything there. They actually lend out the money. So this happened due to the consumption smoothing theory. Remember this word? The consumption smoothing theory. Okay. Went wrong. Okay. The consumption smoothing theory, we covered that. Okay. Let's go back to the notes here. Oops. This one, consumption smoothing theory, that the bank only keep a small portion of depositors' money in the bank. Large amount of the deposit are actually lent out. So in normal business circumstances, the bank only expect a small percentage of depositor will come to the bank each time to withdraw money. But if there's a sudden shock in the market, bank run large number of depositors withdraw money from a bank, they will not have enough cash to hold. So the liquidity insurance theory or consumption smoothing theory goes wrong. That is illiquidity. Okay, so you just explain all that. Okay, next one, insolvency. Okay, insolvency. Okay, this happened mainly due to two aspects normally. Either the bank has been suffering operating losses for a few years, or a large number of borrower default payment over a long time period, for 1 year or 6 months or more than that. That a lot of borrowers start to default. Okay, so all this happen result in the bank capital to shrink. So income statement, the profit eventually go to capital. When the bank made a lot of profit, when the business made a lot of profit over time, this profit all add to capital. But if there's losses, the losses is deducted from capital, so the equity capital gets smaller and smaller. Or when there's a lot of default, there are a lot of bad debts. And then all these loans, the asset of the bank keeps shrinking, so asset become very, very small. And so this happened that over the time the capital being write off. So you may come to a very worst scenario is where the liabilities of the bank start becoming larger than bank's assets. Or any business, not necessarily bank, any business, when this happens, you are near to bankruptcy. So you are no longer a going concern. So you are no longer a going concern in accounting term. Okay, but this doesn't happen overnight, not unexpected. This is normally expected, and a slow process. Okay, now example is the Lehman Brothers, the Citibank and all that during the global financial crisis of 2007. They know that there's a problem, but they tend to hide the problem. So Lehman Brothers know they have problem, but they hide. Even the auditors also hide for them, so the auditors get in trouble as well. So that is a different issue. That is transparency issue. But the problem is already there. Okay. So what's the relationship between these two? Well, both can actually cause bank failure. The relationship, that's the question, right? Make sure you answer fully, always. So the question asks for the relationship between them. Okay. So either one or both they may occur separately or they may occur together. If they occur together, then of course the impact is even worse. Okay, so that is the first answer: illiquidity and insolvency. All right, next question. Okay, explain operational risk and market risk as it affects bank. Give example. Okay, now operational risk, market risk, okay, that comes under different types of risk. So it's this one. Operational risk and market risk. Okay, this one. So market risk, operational risk. Okay, you just explain this. Now, so okay, back to the question. So two things: you need to explain operational risk, you need to explain market risk, you have to give examples. 5 marks question. So okay, part B. Okay, market risk. Okay, now this is the risk arises due to fluctuation in the share security prices, fluctuation in the market securities prices, fluctuation in the treasury bill price, in the share price. Okay, so because of this fluctuation, banks suffer capital loss due to fluctuations in the security prices that they invest. Okay, now one good example is that same thing in the Silicon Valley Bank. Okay, they also give example. So SVB, the Silicon Valley Bank, that the treasury bill investment when this bank buy all this treasury bill in 2020, where the bank have a lot of cash, because SVB invest in technology company. So during the COVID time, technology company is booming. So a lot of these technology companies save a lot of money in the bank. So the bank use this money to buy treasury bills. In 2020, treasury bill price was very low. So when the interest rate is low, the bond price is high. Bond price interest rate are inversely related. So the bank actually bought this treasury bill at very high price. But when the bank run happen, the bank need urgent money. So they are forced to sell this treasury bill at 2023 price. 2023 interest rate was very high. So the bond price was very low. So the bank forced to sell all this treasury bill at very low price. So it suffered huge capital loss. The SVB actually been forced to sell the treasury bill at very low price because they need urgent money to tackle the bank run. So they suffer huge loss. Okay. That's one example. Another example is the securitization process, the MBS, that prices crash in the global financial crisis of 2007. So again, banks suffer huge capital loss in the MBS security. These are two very big examples that you can quote. Will be good you quote this. That's market risk. Okay, operational risk. Okay, this refers to the financial loss suffered by banks. Okay, due to operational mistakes or fraud. When there's money laundering. Okay. When there's terrorist activities, when there's IT problem. Okay. This risk has become increasingly wider now because of online banking. So IT fraud has become increasingly more and more serious. Because of advancement in technology, because of focus on online banking. So that's operational risk. Okay. So example you give, money laundering problem, IT problem, okay, computer hacking. Okay, next part. Okay. Explain credit risk as it affects banks and discuss the techniques banks can use to manage the moral hazard created by credit risk exposure. Okay. Explain credit risk. 1. Techniques banks use to manage credit risk, focusing on moral hazard. So you don't explain techniques to manage adverse selection, then you won't get marks. The focus should be moral hazard. Okay, so first explain credit risk. Okay, now credit risk cover the risk of default. When the borrower do not pay the loan or interest on the loan on when they become due, on agreed time when they become due, then the bank will suffer risk of bad debts. So that's credit risk. Okay. Now credit risk arises because of asymmetric information. Adverse selection, moral hazard. Adverse selection is when you do not have enough information about the borrower, then you tend to lend money to people who are not really in good credit. That's adverse selection. To deal with that problem, you got to get correct information about the borrower, you got to study them, yeah, and then when you have this free riding problem and all that. So that is adverse selection. Yeah, you choose the wrong borrower. But the question do not want you to talk about that. Yeah, they want you to talk about moral hazard problem. This is after you lend the money. What is this? Okay, the borrower use the money that they borrow from you and go into risky activity, or they don't even go into the project that they intend to. Yeah, the company borrow money from bank and say they want to build factory, but actually there's no factory. And the factory is just on paper. They don't build at all. Okay, so that's moral hazard, where the borrower use the borrowed funds to invest in risky projects, or even no investment at all. The investment is just a lie to the bank. Yeah. Then there's a high risk that they are not able to pay back the loan because there's no project, there's no profit to pay. Yeah? So therefore, high risk of default, and the bank can get in trouble. Okay, so how to manage this? Well, in the class we have covered these few things here. Okay, how to manage this moral hazard. Monitor the borrower activities. Yeah, okay, after you lend the money, you must check what they are doing, right? Debt covenants, yes, debt covenants, built-in covenants in the contract. Yeah, so okay. Techniques to monitoring. Okay, you have to do your audit. You got to check. Yeah? So if they say they use money to build factory, you must actually go and see whether the factory is being built. Yeah, like, is there any construction going on in the factory? Okay, so monitoring and build covenants into the loan contracts. Yeah, attach condition to the loan, what they must do, what they cannot do. Okay, build covenants into that. Okay, now. Okay, once you build covenant, you need to monitor, yeah, whether they actually fulfill the covenants. You don't set condition and you forget about it. So again, you need to monitor. That's where we have this word delegated monitoring. Put in that. Yeah, monitoring is time consuming and expensive. Okay, so it makes sense to delegate the monitoring to the bank because the bank can do it more effectively and cheaper, because the bank have economy of scale, economy of scope, the bank has expert, and they use technology. Always these 3 points. Yeah, so that's the idea of delegated monitoring comes in. Bring in that point. Delegated monitoring. Okay, so it makes sense for investor to save the money in the bank, let the bank lend out the money, and let the bank do the monitoring. Delegate the monitoring to the bank. Yeah, because they have economy of scale, economy of scope, they have technology. Delegated monitoring. Yeah, so end with this. Okay, that will give you a good answer. Yeah, so this one in more details. Okay. Okay, that is this first question. Okay. Okay, now second question, explain how bank able to act as intermediaries by reconciling the requirements of lenders and borrowers and reducing costs. Okay, how bank able to act as intermediaries? By reconciling the requirement of lenders and borrower. So this is the functions of financial intermediaries. How you reconcile these two parties. The keyword is this: how you can reconcile the conflicting requirement of these two parties. Okay, so maturity transformation. Depositor want to be able to withdraw their money from the bank anytime, but borrower want fixed repayment schedule. Bank act as this maturity transformation. Remember? So it's the role of financial intermediaries. So the answer is this one. Maturity transformation. Okay. Size transformation. Okay. Depositor, when we keep money in the bank, we keep in small sum. Right? $2,000, $5,000, $10,000. Okay. So depositor keep money in the bank in small sum, but there are many depositors. Borrower, when they borrow money from bank, they normally need it in large sum. You buy a house, you need $500,000. Yeah. So without the bank, in order for you to buy a house, you will need to borrow money from many individuals. But with the bank, you just need to borrow from one bank. So the bank help to accumulate fund from many depositors. That's size transformation. Yeah, the bank help to accumulate funds from many depositors. Okay. Now liquidity transformation. Liquidity is cash. So although investor or depositor put money into the bank and the money is eventually lent out to the borrower, but if the depositor need cash, they can actually withdraw the cash from the bank anytime. You don't have to worry, even though your money has been lent out, but you are able to withdraw money from the bank anytime that you wish. So your deposit in the bank is as good as the cash flow in your hand. You can take out anytime. Yeah, your deposit in the bank is as good as the cash flow in your hand. Okay, provided consumption smoothing theory apply. If there's a bank run, then this liquidity transformation will not happen. Yeah, so this can work in normal condition. If there's a bank run, this will not happen. Okay, risk transformation. Yeah. So when the borrower default, the bank absorb the risk of bad debt. Depositor do not lose their money. Okay, I've given you detailed class notes on this four. You go back, check the notes. Yeah, so I don't have to repeat here. Okay, so I've given you detailed class notes. Yeah. Okay. So this is how the bank or financial intermediaries reconcile the conflicting needs between depositors and borrower. That's the question, right? Okay, how they can reconcile the conflicting requirement. These four functions. Okay, then the next question is what? How they can reduce costs. This point. Economy of scale, economy of scope. They have expert and they use IT. I've also given you detailed notes, right? Yeah, the class notes for all this. Okay, so the answer to question 2 part A. I put it here. Question 2 part A. Okay. Functions or roles of financial intermediaries. Okay. Function of financial intermediaries. Okay. Financial intermediaries serve four main functions to reconcile the conflicting requirements between lenders and borrowers. That's where you explain. 1, 2, 3, 4. Okay. Maturity transformation. Okay, you explain. Maturity transformation. Okay. Size transformation or credit accumulation. Okay. Liquidity transformation. Risk transformation or risk absorption. Okay. When you explain this, you can also talk about the consumption smoothing theory. No need in detail, because the detail will be the second part. Just mention only, no need detail. Okay. Okay, but the whole question is how many marks? 12 marks. So they need some point there. Okay. Okay. So give some explanation of that. Okay, then how the bank can reduce costs. Okay, so that should be your second subheading. So your first subheading is this: functions of financial intermediaries. Okay, your first subheading. Intermediaries. Okay. So your second heading. Okay, reduce costs. Okay, that's where the 3 point there you explain. Economy of scale, economy of scope. The bank has experts and they use IT. Okay. Alright, that's first question. Okay, the second question. Explain Diamond theory of delegated monitoring and discuss its contribution to our understanding of financial intermediation. Okay. Delegated monitoring, this point. This is Diamond's theory. Delegated monitoring. Okay. This is Diamond's theory. Okay. Okay, so I put there page 34. Okay, now I have a summary here on page 34. Okay, delegated monitoring, this is Diamond theories, something quite common. So this is just key point. You should support it with your subject guide. Okay, all the commentary. I think this 2020 the commentary is quite good. Some sitting the commentary is very brief, but this 2020 they give quite a good one. So maybe I refer you to that. So question 1, this commentary was quite detailed. So liquidity, when the bank short of cash, see. So depositor withdrawal, bank run. Okay, insolvency arise from credit risk that many borrower default. Okay, or the bank asset value fall. Bank suffering operating loss. Okay, operational risk. So okay, operating risk, market risk also explained here. See, MBS, CDO, they mention this. They don't mention SVB because this question is 2020. SVB problem haven't come out yet, so they use MBS. Okay, right, credit risk. Okay, covenant. But this one a bit brief. Okay, you cannot write so brief. It's long 10 marks question, right? Go detail like the one I said just now. But the part A and part B is good. Okay. Question number 2. There are all these transformation roles. I mentioned that just now. Okay. Delegated monitoring was covered quite well here, so you can use this as your guide. Diamond theory. Okay, so I think it's good you go through this. Delegated monitoring. Diamond theory. The main idea of delegated monitoring theory is that since monitoring borrower is cost-free, it is efficient for surplus unit, the lender, to delegate the task of monitoring to specialized agents such as bank. So you don't lend money directly, or you don't invest in the financial market. You put your money in the bank, let bank lend the money, and let bank do the monitoring. So bank have comparative advantage relative to direct lending in monitoring activities in the context of cost-free state verification. So because the bank have economy of scale, economy of scope, all that. Okay. And then these are additional support. Right? Additional support. So this is a good answer. So if you get question on diamond theory, or they won't use the word diamond theory, sometimes they just say delegated monitoring. So this will be the good answer. Okay, go through this. Okay, this is 2020 question 2, right? 2020 question 2. Okay. Okay, right. I will finish off this paper with question 3 because question 4, asymmetry information, moral hazard problem, all that already explained in the previous video. So I finished with question 3. With reference to example, discuss the characteristics and consequences of financial bubble. Okay, a common question on financial crisis. Okay, financial bubble. So question number 3. So I put it here. Okay. Part A, financial bubble. Okay. Financial bubble occurs when asset prices are overinflated. Right? Asset prices are overinflated due to high demand. A lot of people buy the asset. Okay? So the definition of financial prices, asset prices are overinflated. The market price for the asset is much higher than the fair value. The market price of the asset is very much higher than the fair value. Okay, and it happened in 3 stages. There are 3 phases. You explain the 3 phases, 1, 2, 3. Okay, which you can get directly from your notes here. The 3 phases of financial bubble. Where is financial bubble? Here. Okay, so everything is here. Explain financial bubble, the 3 phases, right? Okay, then with example. So after you mention these 3 phases, you must give example. Okay, so you can give example on just pick maybe to read mania if you want. Brief example, no need in detail, just briefly. Okay, that the TURIP become overinflated in price, or the global financial crisis when the property overinflated, or the Asia financial crisis, the currency overinflated, Asia currency, or internet bubble. You give example. So pick. So after that, you give example. Okay. So you can give example from the global financial crisis 2007, that the property price bubble. Okay, or the Asia financial crisis of 1997, yeah, that the Asia currencies bubble. Okay, or you can give the internet bubble, the bubbles in the internet company share, year 2000, yeah, like Amazon.com, like eBay's, okay. Okay, that's part A. Now, part B. Discuss empirical evidence on market underreaction in the context of weak and small semi-strong form efficiency. So this is EMH. Market underreaction, 13 marks, yeah? Okay, now. So, your answer will first explain EMH. Okay? Theory on share price, EMH, yeah? Okay, the theory based on where we have an efficient market, perfect market, meaning new and unexpected information reaches all investors at the same time, right? New and unexpected information reach all investors at the same time. Efficient market. Because of that, there is no abnormal return. Yeah, so market becomes stable. All that I already explained in the class. Okay, now then we have three forms of EMH. Yeah, and the question mentioned weak form, and the question mentioned semi-strong form. You got to talk about these two first. Yeah, so weak form, the share price reflects. The share price reflects past information only. Okay, past information only. Semi-strong form, the share price reflects public information only. Okay. Okay, the focus of market underreaction and overreaction should be on this semi-strong form. Okay, so the focus is on the semi-strong form. Okay, so when announcements are made public, then the share price will move significantly, either up or down. Okay, good information, it goes up. Bad information, it comes down. It will move significantly. Yeah. Okay. Now, the degree of market reaction depends on the type of information. Okay. The degree of market, how much the market react, the degree of market reactions depends on the type of information. Okay, now generally these are the two findings. The markets normally overreact to firm specific information, but the market normally underreact to general market information. Okay, this is the general finding in the market. When there's information very specific to the firm, okay, like during the COVID time, Okay, airline doing badly, almost gone. So the share price dropped like nobody business. People overreact. Yeah? Hotel industry, the share price dropped like nobody business. Okay, or there's any bad information about a company. Yeah, okay. Say for example, Microsoft. If Bill Gates suddenly pass away, then the share price of Microsoft will drop heavily. These are firm specific information. Yeah, or okay, AirAsia. Yeah, so when there's an aircraft accident, yeah, the Asia, Indonesia, the share price drop heavily. So firm specific information, market normally overreact, especially bad information. Yeah, but general information, the share price people react, but not that heavily. Yeah. So for example, okay, the government announced the budget and announced GDP growth has slowed down for last year. Yeah. Well, the market don't really react much about that. So that is the difference. So market normally overreact to firm specific information. You can give example. Okay, so if the key director of a company pass away, the share price will drop heavily. Yeah, but market normally underreact to general market information. So when the government announced that the GDP growth of the country has slowed down, the reaction in the market is quite insignificant. Yeah, okay. Okay, that will be your answer to this one. Alright. Okay, and you can read the commentary also. I think they also do quite well here. Yeah. Okay. See the financial bubble, the three phases you explain in detail. This one not detailed enough. You explain the three phases that I give you. Example, see, .com bubble, internet bubble. Yeah. Housing market bubble. Okay, so this one was quite well. All right. Okay, this is 2020 done. So I will stop this video here. Bye bye.